Welcome to Accounting Space. In this video, I want to look at a question from the question paper of November 2024. The paper was written on 4 December 2024. So we are going to look at question 3 on that question paper. So going to our question, on the first part, we are going to calculate depreciation. So the question reads, Cabot Private Limited decided to purchase a new toilet paper, rolling machine from Japan that cost them 730,000 rands on 1 April 2023. It is the accounting policy of the company to depreciate all their assets according to the reducing balance method to calculate the depreciation, which is the reducing balance method. Remember, the reducing balance method is also called the diminishing balance method, and also it can also be called the carrying value method. So believe that I read the financial director indicated that they depreciate their rolling machine at a rate of 20%. The financial period ends on 31 March every year. So all the required parts calculate the depreciation for the next 4 years. So we are seeing that it was purchased on 1 April 2023. So it means the first year is ending 31 March 2024. That's when we have got our first year ending, and the second year ending the following year, 2024. Then we try to look in the next the following year. So the following year obviously will be 31 March 2025. And then if we look at the next financial year and again, it will be 31 March 20. We can just 2026 will be the next year. Remember, they need for the next 4 years. So these are 3 years. So to the fourth year now, we are saying 31 March 2027. So basically, that's how we are going to calculate depreciation. But we take note that depreciation using the reducing balance method, the formula that we are going to use is percentage times carrying value. That's the formula for calculating depreciation using reducing balance method, where carrying value, where our carrying value will be equal to cost of the asset minus accumulated depreciation. So basically, accumulated depreciation, we are saying, is the depreciation of the asset from the day it was bought to the current day, to date. So basically, that's accumulated depreciation. If we have the asset for 3 years, we are saying for the past 3 years, all the depreciations for each and every financial period, we add them together to get the total, and becomes accumulated depreciation. So basically, that's what we have. So that's how we are going to calculate depreciation. So we can start for year one. This is going to be our year one with year ending 31 March 2024 and calculate the depreciation. But we already know that the cost is 730,000. But for the first year, the depreciation is zero because we are just purchasing it. We're just buying that rolling machine. So there's no depreciation yet. So you're saying at the end of the first year, that is at 31 March 2024, we are just going to use 730,000 as our cost and also as our carrying value. So percentage is 20%. So first year we will say 20% of 730,000 rand. So we come here, it's ending 31 March 2024. That's when it's year end. And on depreciation, we say it's 20%. So we're just going to say 20%. And then we multiply by 730,000. So if you calculate, you are going to get your answer is 146,000 rands. So that's the response on year one. Then year two, we are seeing that year two, it's ending 31 March 2025. So again, we make the calculation whereby we are now saying, we are still using the same rate of 20%, so 20%. But now we calculate the carrying value. Remember, our formula is times our carrying value. So for the second year, we now have a depreciation that we've calculated for the first year, 146,000. So it means we are going to calculate our carrying value by saying costs 730,000. Cost is 730,000 rands. We subtract accumulated depreciation, of which we only have 146,000 as our depreciation. So subtract 146,000. So this is our accumulated depreciation. So we calculate, see there. So first of all, you say 730,000 minus 146,000. The answer that you get to multiply by 20%. So 20% is a decimal is 0.2. So you can just say times 0.2. And then the final answer that we are supposed to get is 116,800. 116,800. So this is what we have. And then for the third year, it's ending 31 March 2026. And again, we are saying 20% times accumulated, times cost minus accumulated depreciation or cost. Then you subtract the accumulated depreciation. Accumulated depreciation, we are saying depreciation for the first year plus depreciation for the second year. So we can try to say our 146,000 is our year one depreciation plus 116,800 is depreciation for year two. So we can just try to calculate. And then we're going to get your answer as 262,800. So it means here you're going to say minus 262,800. And you're going to see that here we close brackets. So we first subtract in brackets to get the current value, and then you multiply by 20%. And then the answer that you're going to get is 93,440, which is depreciation for the third year. Then we go for the final year, which is now ending 31 March 2027. So again, 20% times the cost doesn't change, it's 730,000. And now we are saying depreciation from the 16,800 plus 93,440 to get our accumulated depreciation. So we can as well try to calculate as such. And we are going to get it as 356. 356,240. We calculate correctly, you're going to get your answer is 74,752. So basically, that's what we have in that part, which is now our depreciation for year four. So we can now move on to the next part of our question, which is now on 3.2. So on 3.2, this is the information that we are given. So we can also try to. So the 3.2 is the following information was taken from the records of Letabile Private Limited. We even fixed costs, variable costs, and also production in units. So beneath that on the required, it reads calculate the fixed cost per unit if 6,000 units were to be produced. So to get the fixed cost per unit, we are just going to say total fixed costs divided by number of units. For which our total fixed costs we are given it is 500,000 units are within the context of 3.2.1. So that's what how we are going to calculate it. So coming here now, we see that our fixed cost 500,000. Then 500,000 I will divide 500,000 I will divide by 6,000. And we are going to get your answer to two decimal places. It becomes 83 rand 33 cents. So this is what we have. Then we go to the next one, which is 3.2.2. I want to say calculate the total fixed cost if 8,000 units were to be produced. So we are given that fixed cost for 3,000 units is 500,000 rands. So for 8,000 units again, it's the same 500,000 rands. Remember, fixed costs do not change with the level of output. So we are not have, we have the same fixed costs for every level of output. So we are going to take our answer as this 500,000 as the fixed cost. So 3.2.2, we say 500,000 as. Then we go to 3.2.3, calculate the variable cost per unit. So variable cost per unit, obviously, we are going to say total variable cost. Each total variable costs, we're given it is 550,000. And then number of units, we're given as 3,000. So 550,000 divided by 3,000. So coming in, we are saying 550,000. Then we divide by 3,000. So we calculate it like that. You see that the answer that you're going to get is 183 rands 33 cents. So this is what we for that part. And then we go to 3.2.4. Calculate the total cost for the tablet private limited should the production increase to 9,000 units for all your workings. So remember, the total cost, we're going to get it as fixed costs plus variable costs. So basically, that's what we have. So our fixed costs, we know that they do not change with level of output. So we're going to take our 500,000 as our fixed cost. So we're going to say 500,000 rands plus variable cost is the one that changes with the level of output. So variable cost, we have calculated the variable cost per unit here, and then we multiply it by 9,000. So basically, we are saying 183 and 33 cents. Then we multiply by 9,000. So the final answer that we are supposed to get is 2,149,2,149,970. So basically, that's what we have in terms of 3.2.4. So moving on to the next question. We now move on to part 3.3, whereby it reads Cricket Private Limited is to manufacture 530 chairs for the local cricket club. The chairs had to be manufactured according to certain specifications. Then we are given Cricket Private Limited employed 3 employees to manufacture BO34 chairs for them. Budgeted labor hours for BO34. We are given Senzo Makwale, Lion Mezi, and Ruda and Kawota. We are given all of them applied to 24 days at 24 days at 8 hours per day. Then believe that actual labor hours for Senzo Makwale and Yehuda Gawota realized is budgeted, but Leon Mezi had to take 2 days of sick leave. Then we're given budgeted production for BO34, actual production for BO34. Then on the required part, it reads compile the production report for item BO34 for the week ended 16 September 2023, showing the productivity recorded in minutes. So before the production report, you're supposed to show the productivity recorded in minutes. So basically, that's how we are going to go through it before we go to our production report. So going to 3.3. So we are seeing that we are going to start on the hours, whereby we are going to first calculate budgeted labor hours. We're going to first calculate our budgeted labor hours. So here we'll say budgeted labor hours. So basically, that's what we want the first part. we are going to have our budgeted labor hours. Budgeted labor hours, so we can just maybe try to. So on budgeted labor hours, we go to the information given. We are saying 24 days, eight 8 hours per day. So basically, we have 24 days and for the others. So we're going to say 24. We multiply by 8 hours, 24 days with 8 hours per day. But this is applied to three people, 1, 2, 3. So we did multiply by three to get the budgeted labor hours. So we just go there and summarize the search, whereby you're saying 24. And then you're going to, so basically that's what we would budget labor. We are going to calculate actual labor hours. We told that what I realized is budgeted. So it means so it yield. But for Leon, it means it being 8 hours, 16. So this 16 we subtracted the balance. Leon was off. So in other words, if you come here, we are now saying 576 that we calculated there minus give us 560. So basically that's what we have on that part. Then going to forward, we also need to compare budgeted labor hours and actual labor hours to check if it's a favorable position or unfavorable. Remember, we have the actual labor hours being less than budgeted labor hours. So in that case, you are going to see that it's unfavorable. It's an unfavorable position where actual labor hours is less than budgeted labor hours, which means the opposite is true. If you have actual labor hours being more than budgeted, the favorable position. So we come here, we say variance in brackets, it's unfavorable. Unfavorable. So that's what we have. In the unfavorable, it is a variance of 60, whereby you say 576 minus 560. And then you go to the next part, which is now on production. So we are going to compare budgeted production, with actual production. So we can start with our budgeted production, whereby we go to information given, and you see that budgeted production is 530 chairs, and then actual is 480. So with such, here we've got 500 and 30, and here we've got 480. That makes budgeted more than actual. So we produced less than we expected, so which is not a favorable position. We produced less than what we expected to produce. So that's unfavorable. So by how much? By how much now? So it means these are figures that are also going to come here: 530, 480. So by how much now? We say 530 minus 480. It was 550, but this is unfavorable. Unfavorable. So basically that's what we have on that part. Then we go to productivity. So on productivity report, now we are now saying we are going to calculate now. Remember, productivity report, we are trying to evaluate the employee's performance. It's an evaluation of the employee's performance. So we are going to calculate budget time per unit, and then we also calculate budget time uh, used per unit. So basically, that's what we the actual the actual time used per unit. We compare it to budgeted time per unit. So if you can understand it from that perspective, we are not saying budget time per unit is the first one. Budgeted time, budgeted time per unit. So to calculate budgeted time per unit, we go back. We see that we've got number of hours that we calculated is budgeted. We can just refer back. We have 576 labor hours. These are the ones that are budgeted. And then we multiply by 60 minutes. Remember, we put 60 minutes in 1 hour. These are number of hours, 576 hours. So we convert our hours to minutes by multiplying it by 60. So after we multiply by 60, we divide by the budgeted production, which is 530. Then we can get now the budgeted time per unit. So basically here we are saying 576 hours multiplied by 60 minutes. And then the answer that we get, we divide by budgeted production, which is 530. Then we get the 21 to decimal places, minutes per unit. Then we do the same thing for actual. We know that the actual hours, we have actual labor hours by 560, we multiply by 60. Then we divide by actual production, which is 480. So we come here, we say actual actual time used per minute, actual time per unit. So basically we are saying 560, and then we multiply by 60 divided by we divide by the actual production, which is 480. And then the answer that we are going to get is 70 minutes per unit. So here we are saying 70 minutes, 70 minutes per unit. So basically that's what we have. Then you are supposed to come up with a conclusion. You are supposed to come up with a conclusion because obviously the conclusion now, you are basing your conclusion on a productivity in terms of number of minutes per unit. So obviously the favorable position is where we have less time per unit. If actual time is less than budgeted, it means time spent on each and every unit is less, which is representing efficiency. So that's the favorable position. So we can just conclude by saying the employees spent more per unit, as we are seeing that actual is greater than budgeted. So they spend more per unit, and also they produced less. If you took at production, they produced less again than expected. So basically, they were not productive. That's the conclusion. They were not productive. Remember, we are checking the performance of the employees. So basically, we are saying in our conclusion, the employees spent more uh, more more time per unit and produced less units than expected. Therefore, therefore, they were not productive. So basically, that's the conclusion that you can give after making comparison of productivity and also on production, which has given us a comparison of actual production and budgeted production. So basically, this is what we guys on question 3 on the question paper of November 2024. And please, let's take note, let's stay tuned for more questions on the question paper of November 2024. Let's stay tuned for more videos to come. Thank you for listening, and let's meet again in the next video.